Thanks so much for stopping by the Mortgage Moment channel on YouTube. Please don't forget to hit the subscribe button up there, or it might be up there. By subscribing to our channel, we'll ensure to keep you up to date on any and all of the latest updates, be it FHA, conventional, for buyers or sellers. So we appreciate you stopping by today. The topic of conversation today is an important one. It's a confusing one as well, and it's asked consistently by all of my buyers when they're at the closing table. Mark, just when can I get rid of my mortgage insurance? Great question. So let me clear up the two types of mortgage insurance that are available out there currently today. One for conventional and one for FHA. Let's talk about conventional first. You need to know that in order to remove mortgage insurance, you can contact us or contact your servicer directly. Those are the people that are sending you the statements each month, and petition them to remove mortgage insurance if you've been in the home for 5 years, if you believe your value to have increased so that your loan balance is now 78%, not the old 80% rule we've all come to know and love. So for an example would be you bought a house at $78,000 and now it's worth $100,000. That would be a good occasion for us to remove the mortgage insurance. You do need to know that you cannot have paid down the mortgage balance in order to get MI dropped off. It must be removed over time by making the monthly payment. You can refinance out of it if the value is there and you find that you have sufficient equity in the property to complete a refinance. You can oftentimes refinance the mortgage insurance off. That's kind of an expensive option just to do that unless you can get a significantly reduced rate. You also need to know that there can be no lates in the last 12 months, and since acquiring the property you cannot have added a second mortgage. So some tips to know there, very wise information to put in the back of the make a mental note about, especially when it comes to conventional loans. But if you forget anything in this video, you can always contact us or read the blog that's directly below. I put a link in for you to click on so you can have a reference source and bookmark. Let's talk about FHA. FHA is a little different but similar. Federal Housing Administration says that you need to be at a 78% loan to value as well. You must have paid on it for at least 5 years. However, unlike conventional, you can actually pay this mortgage down. You could have, for example, bought an REO or a short sale in the last couple of years and have improved the property, done a room addition, done a pool. Anything that would substantiate an increase in value that can be appraised, that can get you to that 78%, we can use, unlike on conventional. So you need to know about that, being able to refinance out. You can pay down the mortgage, but typically it needs to be about 5 years holding the mortgage before FHA will look at it. Are there some exceptions to the rule? Yes, there are. It's behoovant of you to give us a call and we can check into it for you on your particular case number that's attached to your mortgage. So that's basically a recap of mortgage insurance and how to remove it. The good news is it is still tax deductible. It may be tax deductible for you, so always check with your CPA or your accounting firm to see if you can claim the monthly mortgage insurance premium. As always, thanks so much for stopping by the Mortgage Moment channel. Give us a call at 602-361-0707 or look at the link below in the blog and reach out to us from there. Thanks. Take care.